to me, I still think the balance of risks are somewhat to the downside, and I think the cost of cutting unnecessarily is much lower than the cost of not cutting if we in fact need to. But I'm comfortable with where the committee is.
That was Minneapolis Fed President Neel Kashkari just moments ago, and joining us right here on the Squawk Box is the one and only Peter Kraus. We want to talk to him about the state of the Fed and everything else that's going on here. I want to know about how you're actually positioning yourself. After all, we've had so many conversations.
Yeah.
We're sitting on the sidelines with cash and this and that.
Yeah. So
where are you now?
Look, I do think things have changed a bit to the upside to Joe's constant drum beating. You know,
I just didn't think you should be negative at 2,400 on the S&P. I'm not beating any drums, but you know, you're in the investment business. It's probably not a good idea to be out of the market for 50% of the move. But that's just me. You know, if I were your client,
I didn't say I was out of the market. I said I wouldn't put more cash.
You wouldn't go back in at 2,700 until we were back down at 2,400.
That is correct. That's what I said. Yes.
Okay.
Okay. So here we are.
I stand by that. Yeah.
Well, you stand by that, and here we are. So what are you doing now?
Yeah. So I think I do think the market's going to run a little here.
You do?
I do. Yeah, I think.
And run a little hot here?
I think.
Is this the last leg?
Well, look, you never know that, but I would argue, yes, it's becoming a lot riskier. If you look what's going on inside the market, so the faster-growing companies that had actually higher valuations have topped out. There's no positive convexity in the upside when they report earnings.
Right.
And the companies with lower multiples are actually growing in value. And so, you know, that's a shift inside of the market. Now, how much higher can the market go if the only thing that's really going up is the lower valued companies? Not that they're bad companies, they just carry lower valuations. And so I think you're reaching a point where the market's going to sit there and say, okay, is there a reason for a leg higher? Am I really going to have a change in global growth? And right now, and we just heard this from Neil, you know, global growth is slowing. And global growth is slowing in manufacturing all over the world. Japan, Germany, China. But the good thing about the United States today is manufacturing is 12% to 15% of the GDP. And so we're having a manufacturing recession, but it doesn't really matter in the United States. What matters in the United States is the consumption economy, and the Fed dropping rates actually juices the consumption economy in housing and cars and consumption and other aspects of the consumer business. How
does the fact that we are entering an election year play into your thoughts, given that we were just having a big debate about if Elizabeth Warren is the
good question.
Nominee, how that
most administrations over history, when they're in an election year and there's an incumbent president, will find ways to spend money. And $1 trillion deficit that we're having this year would certainly fit that bill. And so you would expect, and that's not Republican versus Democrat, they all do it. You know, you would expect to continue to see spending by the federal government. There is no political pushback for $1 trillion deficit, and so we could see the deficit, you know, continue to be at that level or even rise. So if that happens, it's sort of unlikely that you're going to get a slowdown in the consumption economy. And that doesn't necessarily mean, by the way, that the market won't anticipate the end of that and an election and actually falter. But it does mean the economy probably continues to be.
We all want. In the back of our minds, don't we all want to do something with entitlements too? The unfunded liabilities that we have that doesn't even go into our calculations, and yet we're talking about a huge expansion of Medicare, not a means testing for certain people, or I mean, there's sooner or later we need to face these issues.
I am 100%, believe it or not, Joe, in your camp. I think fiscal responsibility matters.
But what about for entitlements? An entitlement for which we don't talk about at all.
There's a whole political trade-off about where you cut. And that could be in entitlements. It could be in defense spending.
But discretionary, you got nothing to cut hardly. It's already.
That is the way we've set up the system. So we need to make political decisions to decide where we're going to.
Spending another $50 trillion on Medicare the way to go? That she's leading the polls.
That's a political question. I'm agreeing with you that we need to actually find a way to reduce.
But we're not talking about reining in entitlements. We're talking about expanding entitlements.
By the way, either has the president for the last 4 years.
Not a word about entitlements. In fact, that was part of the populist approach.
Yeah. I mean, look, most presidents will not cut entitlements. Most Congresses will not cut entitlements. That's why we are where we are. But to have $1 trillion deficit with, to your point, very little flexibility to cut discretionary spending.
If rates do go up.
If rates will go up, by the way, at some point they will go up. Inflation will be in the marketplace, and it's going to be very expensive. And I think, you know, we have to pay that price when it happens. It's going to be unattractive.